Johnson & Johnson stock ticker JNJ, is currently trading at $158.18 per share, and over the past year it's pretty flat overall, up around 2.5%, and it's right in the middle of its 52-week range with a high of around $176 and a low of around $145. Now, this is a popular stock among dividend investors for a couple of different reasons. Yes, the company does have a decent starting dividend yield, sitting at about 3.01%. But look at the dividend history for this company. They've now been increasing dividends for 61 consecutive years. So obviously they have a phenomenal history of increasing dividend payments. But here's what's really interesting about this company. There are only two publicly traded companies with a higher credit rating than the US government. One of those is Microsoft, but the other is actually Johnson & Johnson. So obviously investors have a lot of faith in this company. So in this video, we'll be taking a deep dive into Johnson & Johnson stock. We'll be looking at their latest quarter's earnings report, looking at some of the latest news, looking at a dividend breakdown of the company, and of course, jumping into our stock valuation spreadsheet to find the intrinsic value of this company. And like always, if you'd like to download any of my spreadsheets and also get access to the Ticker Data add-on in Google Sheets, you can head over to Ticker Data at the link in the description. But let's go ahead and jump into it. Again, Johnson & Johnson over the past 5 years up around 14.96%, which really isn't a lot when you compare it to the S&P 500. But let's go ahead and jump into their latest quarter's earnings report. Now, this is a report back in late January, and they're getting ready to actually report their next quarter's earnings here in around a month. Let's go ahead and jump into these earnings report. We can see non-GAAP earnings per share of $2.29, which was narrowly beating the consensus of $2.28. So a slight beat with earnings per share. And we can also see revenue was up. They reported revenue of around $21.4 billion, which was up 7.3% over the comparable quarter, which was also a beat of analysts' $21.01 billion forecast. So they saw a beat on the top and bottom line. Now, if you've been keeping up with Johnson & Johnson for a while, you know that around half a year ago, they actually had a spinoff of its consumer health segment, and it's now known as Kenvue. So you can see they now have their own stock ticker, KVUE, trading at $20.34 per share with a yield of around 2.9%. So what does this mean for Johnson & Johnson? And essentially what this now means for the company is they're now focused on pharmaceuticals and medical device businesses. And pharmaceuticals remains the vast majority of that, generating just under 2/3 of the company's revenue. Now, if we scroll down and look at a quote from the CEO of Johnson & Johnson from their latest earnings report, let's go ahead and read this. We can see, at our enterprise business review, we shared that we expect our innovative medicine business to grow 5% to 7% from 2025 to 2030 with our industry-leading pipeline. That is a big word for a pharmaceutical company, and portfolio delivering more than 10 assets that have potential to generate over $5 billion in peak year sales by 2030. We also expect a further 15 assets to have the potential for $1 billion to $5 billion in peak year sales. Okay, so the keywords that he mentioned here are industry-leading pipelines. Johnson & Johnson operates in the pharmaceutical industry. And anytime you talk about the growth of a pharmaceutical company, it's all about what pharmaceutical drugs do they have in their pipeline. That's where their growth is going to come from. It's why these companies spend so much money in research and development every single year. And if we jump over to Johnson & Johnson's website and look at their development pipeline and scroll down, we can see they currently have 90 different pharmaceutical drugs in their pipeline, with it looks like around 6 currently in registration and the other 84 currently at different phases. So obviously they have a lot in the pipeline right now, so there's a lot of potential growth with these pharmaceutical drugs. So while a lot of people remain bullish on the company because of the phenomenal history the company has and the development pipeline, there are some current struggles that the company is having, mainly with lawsuits. If we scroll down, we'll point out a few of the big problems they're currently having. We can see, first off, about 2 weeks ago, Johnson & Johnson announced the resolution of an opioid-related claim in Washington state, and it led to a $149.5 million settlement. Now, in the grand scheme of things, $149.5 million for a company like Johnson & Johnson, in my opinion, is not really a big deal. If we go ahead and go over to Johnson & Johnson's balance sheet, click right here, scroll down, we can see their cash and cash equivalents as of their last report sitting at $21.8 billion. So really not a large amount. And if we look at their income statement, we can see in revenue, they generated over $85 billion in the trailing 12 months. So again, $149.5 million, not a whole lot of money in my opinion. But here's where things start to get a little bit worse. We can see late last month, Johnson & Johnson reached another tentative agreement to resolve lawsuits, and this one led to a payout of $700 million. So that dollar amount is starting to climb to a territory I don't really like. But here's where things start to get really bad for the company when we talk about the talcum powder related lawsuits. Analysts are currently estimating that Johnson & Johnson will eventually be forced to pay $10 billion to $15 billion for the specific lawsuit. Now that is a large amount that we we do not like to see. Again, if we jump back over to the balance sheet for Johnson & Johnson, like I just mentioned, 10 to 15 billion would potentially be over 50% of the company's current cash and cash equivalents. So we're talking about a major problem for this company. So if you do have interest in Johnson & Johnson, you need to be following these legal issues very closely. Now let's jump into the company's dividend metrics. If we jump over to my dividend breakdown sheet, again, you can download all of my spreadsheets on tickerdata.com at the link in the description. But let's go ahead and come up here and plug in the stock ticker JNJ and hit enter. And you can see all this data is going to automatically load in. Now, like I already mentioned, decent starting dividend yield sitting at about 3.01%. Now, the big question we need to talk about is how sustainable are those dividend payments, and will the dividend payments continue to grow over time? Now, like we already saw in Seeking Alpha, they have a phenomenal dividend history of 61 consecutive years. And if we look at the past 10 years, we can see they've gone from around $2.59 all the way up to $4.70 in 2023, and with their most recent dividend hike, they are now paying out $4.76 a year in dividend payments, giving them the yield of 3.01%. If we look at the 10-year dividend CAGR sitting at about 5.6%, and the 5-year sitting at 4.89%. So that's actually pretty decent dividend growth when you consider the fact they've been increasing dividends for over 60 consecutive years. Now, the free cash flow growth isn't necessarily great, but it is enough to sustain growing dividends. We can see the 10-year free cash flow CAGR at around 2.82%, and the 5-year sitting at about 4.4%. So if we look at one of my favorite charts on the spreadsheet, free cash flow versus the amount paid out in dividends from the company. Free cash flow is our blue bars here, and the red is the amount paid out in dividends. And you can clearly see with the red, they're paying out more and more in dividends every single year, and the free cash flow is doing a pretty good job of completely covering those dividend payments. But if we look at the free cash flow payout ratio over time, we can see for the most part over the past decade, it's sat close to around 50 to 55%. In 2013, it was sitting around 52. We can see 2015 around 51. Move forward, 2017 around 50%, move forward to 2019 around 49.79%. But if we look at the last couple of years, it started to climb a little bit higher. We can see in 2022, free cash flow payout ratio of around 68%, and in 2023, free cash flow payout ratio of around 64.5%. So a growing free cash flow payout ratio isn't really something I necessarily like. But we can also see if we come back down here to this chart, this is the result of the free cash flow of this company slightly dropping over the last couple of years. But again, overall, I feel like these dividend payments are pretty safe, and we'll see slow but reliable dividend growth moving forward. Now lastly, let's go ahead and jump into our valuation. We'll go ahead and come up here and plug in JNJ and hit enter. And one thing on our screener page that I do want to point out is a very low beta sitting at 0.53, so you should see very low levels of volatility with this company. If we jump over to the first valuation we're going to use, typically the first one we look at is Graham's valuation, but I typically don't like this valuation quite as much for more mature companies like Johnson & Johnson or Coca-Cola, so we're not going to use it in this scenario. The first valuation we'll use is going to be our discounted cash flow analysis. Again, we're just projecting how much future free cash flow this company is going to produce to find the intrinsic value. So we look at things like the historical free cash flow and analyst expectations. With all that being said, I projected a growth rate of 5% to the future free cash flows of the company, which like we saw is just a little bit higher than that 5-year free cash flow compounded annual growth rate. But after we've done that, applied a discount rate of 8%, added the company's cash and cash equivalents, subtracted out the total debt. To get our equity value, we divide by shares outstanding to get a discounted cash flow price per share of $148. Now here's the thing about this discounted cash flow analysis. This doesn't account for all the costs that Johnson & Johnson has coming up with the lawsuits. So just as an example, let's say that it completely wiped out all of their cash and cash equivalents. I'll go ahead and delete this out, and we can see that would bump the discounted cash flow price per share down to around $139.42 per share. So that's definitely something you need to be aware of when looking at the discounted cash flow analysis. Now the last valuation we're going to be using for Johnson & Johnson will be our dividend discount model. Again, this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So when we look at Johnson & Johnson, we're assuming a dividend growth rate of around 4.75%, a discount rate of around 8%, and that gives us a dividend discount model price per share of around $153.42, which is pretty close to that current trading price, only off by around 3%. So when we jump over to the output tab and look at the two valuations that we use in this scenario, the DCF at around 148 and dividend discount model at around 153, we come to an intrinsic value of around $150.69, which is only around 5% off from the current trading price for this company, so it looks like it's trading pretty close to fair value. But with a 10% margin of safety, you could see our acceptable buy price at around $135 and a 20% margin of safety around $120.55 per share. Now, Johnson & Johnson, this is a dividend king with over 60 consecutive years of dividend growth, and this is also a company that has a AAA credit rating higher than that of the US government. Now for that reason, a company like Johnson & Johnson is likely to trade at a slight premium. But we can see in this scenario that's actually not the case, as the intrinsic value is slightly below the current share price. And in my opinion, it is pretty likely that that is due to the lawsuits. One of the things that investors really hate is unpredictability. And so when we look at a company like Johnson & Johnson that has a lot of potential lawsuits that could be very costly for the company, it's not really predictable what will happen. That's definitely not something that investors like. So as for me, Johnson & Johnson is really not something I'm considering adding to my portfolio right now. Regardless of the lawsuits, this is more of a slow growth company at this stage of their lifespan. Now, if you're someone who's looking for a steady stream of slow growing dividend income, this could be a good option. But as for me, I'd really only add shares of this company to my portfolio if I felt they were trading at a great value. But there you go, there is an analysis of Johnson & Johnson stock. Go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on to allow you to automatically import a stock financials into your spreadsheet, you can head over to tickerdata.com at the link in the description. But with all of that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.